This part of the presentation on financial crisis gives a chronology of U.S. financial crises since the outset of the 20th century, and this is a summary of the five major crises: the 1929 market crash, the Great Depression that followed it, the S&L crisis of the early 1980s, the mortgage crisis of 2007, and the financial crisis in the wake of it that began in 2008 and actually continued really into 2010. So first, the 1929 market crash, and a good place on the internet to read a critical assessment of it is in this web link right here, posted by The Economist. And it is known as the crash that is the most devastating market crash in US history, and signaled the longest lasting economic downturn to ever occur in the United States. And prior to that, the stock prices doubled between 1928 and 1929. So this period was when there was a significant bubble in the stock market, and which is often the case prior to most financial crises. The Dow peaked up to 381 points right before the financial crisis, and many analysts blame what happened to high stock price speculation and information asymmetry. So a lot of people were expropriated in the process. They were cheated because they didn't quite have as much information as others, and as a result, lost a lot of money. So this picture shows you what happened right in the wake of the market peak on, as I mentioned here, September 3rd, 1929. And this is a crash right here. It was actually a two-day event on October 28th, Black Monday, and October 29th, Black Tuesday. Combined, the market lost 25% of its value on those 2 days. And then you can see the precipitous fall that continued afterward. And in fact, the market didn't try to recover a little bit until in around 1934, 35, and even then, never really went half as much as where it was prior to that time. And then we saw another collapse right here in 1938. So this is the period of the Great Depression. But I put this out here to give you a glimpse as to what happened in the periods right before the crash occurred. You can see that from 1920 to 25, the market doubled. And then 3 years later, the market again doubled. And then you can see what happened on October 29th. So October 29th, the markets, which already had started to flagell, go down a little bit, from the 26th rather into the 28th. We saw the 13% drop. October 26, 29 was a Friday, I'm pretty sure. And then Black Monday after the weekend was on October 20th, 1929. So from here to here is a 13% drop, and from here to here is a further 12% calamity, and that's what this is showing. So this was the big trouble point, and a couple of things. At this time, the Fed, prior to what happened on Black Monday, the Fed was worried about the stock market bubble. The Fed itself was created in 1913 and was really worried about the growing stock market speculation and stock price bubble at that time. And in response, it began raising interest rates, short-term interest rates, and but that caused industrial production to decline in the spring of 1929. Which was really the second quarter of that year, leading to a negative economic growth by the summer of that year of 1929. And so a recession had begun. And then in the 2 months before the stock market crashed on October 28th and October 29th, industrial production fell at an annual rate of 20%, which was really, really huge. And in those 2 days, the Dow lost 25% of its value, as I showed you right here. All right. And by the middle of November of 1929, which is toward the ending of the year, the market had already lost more than half of its value. So these are 2 days of infamy, and what happened thereafter was the Great Depression that continued for many, many years. By 1933, which was 4 years later, um, about half of U.S. banks failed on account of bank runs and widespread bankruptcies. And so a little bit of the narrative is summarized right here for you. The second then was the Great Depression, which came in the wake of the stock market crash of 1929. It was obviously the worst financial crisis the US had ever witnessed. There was a severe price deflation, about 25% price decline. Unemployment shot up, in some cases, up to 30%. And by 1933, which I mentioned earlier, um, 11,000 of America's banks um, went belly up. And this also led to a global financial crisis, even though the world of globalization wasn't then what it is today, but because the US was a major creditor and financier of post-World War I Europe, Great Britain and Germany were particularly affected because of the linkage that the United States economy had with those two important European countries. And so a little bit of the narrative of that is provided here for you. And actually, I would have to note that many critics argue that actually the high jobless rate at the time in 1933 and beyond was due to Roosevelt's New Deal, which was actually a program designed to help restore the U.S. economy by President Roosevelt. As it turned out, though, as was evident later, it was actually the massive spending for World War II instead of the New Deal that helped jumpstart the U.S. economy for good. And eventually, as you may have learned, restored full employment in the economy. The Securities Act of 1933, which came right about the time that about half of U.S. banks went out of business, was enacted by Congress in response to the market crash and the deepening recession, which had become a depression. It was designed to fix two important things, information asymmetry, to make sure that no one was expropriated in the financial markets, no one was cheated, that is, and two, to make sure that there was transparency, in the markets. And so, as a result, the very next year, 1934, the Securities and Exchange Act was enacted, which established the Securities and Exchange Commission as the police officer of the financial markets. So, as you would imagine, the key responsibility of the SEC is to enforce the provisions of the Securities Law of 1933 by providing governance of securities transactions in the secondary market, and thereby ensuring, going back on the slides, transparency in financial statements, and to ensure that there was no misrepresentation or fraudulent activities, such as insider trading of financial assets. So, continuing, the third financial crisis was the savings and loan crisis of late 1970s, early 1980s. So now this was a crisis that was centered in the thrift industry. The thrift industry consists of the savings and loans, savings banks, and credit unions. But primarily, this was a problem with the savings and loans. Now, what happened prior to this point was there was a certain regulation or legislation called Regulation Q, which uh, kept S&Ls from paying high interest rates on customer deposits even when market interest rates were high. The law was well intentioned. It was designed to keep them from shelling out too much money in interest payments to their customers so they could keep more of their money for investment purposes. Keep in mind that SNLs are designed for small investors and small customers. So it was well intentioned, but as it turned out, many depositors, as I note here, withdrew their funds from savings and loans when market interest rates were high and then invested them directly in money market funds and other money market accounts out there where they could earn higher interest rates. The process of withdrawing your money from from a financial institution and then investing directly in the financial markets is called disintermediation. Intermediation is going through a financial intermediary, that is. So the huge pullout of money from these SNLs led to the collapse of many of these institutions. So we had a crisis because then many depositors were losing their money. There wasn't necessarily a deposit insurance to the point where a maximum deposit could be protected. So in response, Congress passed two important legislations: the Depository Institutions Deregulatory and Monetary Control Act of 1980, aka DIDMICA, and subsequently the Depository Institutions Act of 1982, which is also called Monetary Control Act of 1982 or Garn-St. Germain Act of 1982, named after the two senators that sponsored the bill. So these regulations phased out Regulation Q eventually so that thrift institutions, SNLs, can now compete in paying market interest rates on customer deposits, such as money market deposit accounts and savings accounts and stuff like that. However, as is often the case, this deregulation went too far. Well, at least the way that SNLs took advantage of the open access went too far. Many of these SNLs were buoyed to move into investing in very risky banking activities, and including the credit cards, high risk commercial and real estate loans and stuff like that, and especially in junk bonds, of which Ivan Boesky in Wall Street at the time in the 80s was notorious for. Quite infamous, I might add. So many SNLs collapsed when these investments turned sour. So as you can see, they went on a seesaw. First, they lost customers and suffered a cash run on account of customers pulling out their money when market interest rates were high. And two, when Congress said, okay, now you can go ahead and compete. You can pay whatever interest rates that you want to pay, and you can invest in any investments out there that's within the law. Since prior to that point, they were primarily restricted to personal mortgage lending activities. They went too far and again began to fail on account of high risk investments out there. In fact, many SNLs failed so much so that the Federal Savings and Loans Insurance Corporation, FSLIC, the deposit insurance agency for these savings and loans itself, was forced into bankruptcy in the late 1980s. And in response, Congress passed the Financial Institutions Reform, Recovery, and Enforcement Act of FURIA of 1989, which, among other things, um, expanded the powers of the FDIC, the Federal Deposit Insurance Corporation, the insurance agency for commercial banks, to dissolve FSLIC and take over its activities. So that's how FSLIC went out of the picture. And now we have FDIC insuring bank customer deposits in all depository financial institutions. We already have discussed the 2007 mortgage crisis in the previous presentation, and also we have talked about the 2008 financial crisis in the previous presentation. So, in a nutshell, these are the five major financial crises we have had in the United States since the early 1920s.